Aloha mai kako. It's now 2:03. We're going to call this meeting to order. Welcome to the meeting for the Committee on Investments and Land Management for Wednesday, April 2nd, 2025. I'm your chairperson, Keone Sosa, as we've learned. We also have Vice Chair John Waihee IV. Can I get a roll call, please?
Trustee Ahuna?
Aye.
Trustee Akaka?
Here.
Trustee Akina?
Aloha mai kako.
Trustee Alapa?
Present.
Trustee Galutaria is excused. Chair Kahele? Trustee Lindsay? Trustee Waihee?
Present.
Chair Souza?
Ayo. All right, motion passes. We have quorum. First of all, I'd like to acknowledge our board counsel, Naiwieha Wurdeman. And joining the trustees today is Kapohana, Stacey Ferreira, along with numerous support staff. I'd like to call on Pohana to announce the administrative staff joining us this afternoon.
Mahalo Chair, Vice Chair, Trustees. Joining us in person and online is our Chief Operating Officer, Kehau Pu'u, Chief Financial Officer, Ramona Hink, Endowment Director, Ryan Lee, Interim Corporation Counsel, Everett Ohta, Interim Senior Legal Counsel, Nichi Ozawa, Interim Director of Land Assets, Lori Walker, IT Systems Engineer and Administrator, Daniel Santos, Solutions Delivery Technician, Kelsey Wade, and Commercial Property Agent, Leanne Gentry. Mahalo.
Mahalo, Stacey. All right, this meeting can be viewed via live stream on OHA's website at www.oha.org/livestream. If you'd like to testify on any agenda item during the Zoom meeting, please raise your hand when that item is announced. When called upon, please unmute yourself. You'll be given the ability to turn your camera on during your testimony. Once you're finished, we ask that you mute your microphone. We're recording today's meeting for the sole purpose of producing written minutes, which will become the official record of this meeting. And I'm going to read this next part in anticipation of testifiers this afternoon. Our public testimony should be limited to matters listed on the meeting agenda and will occur prior to any listed item's conclusion or vote. If you begin to address other issues not on today's meeting agenda, the ILM chair will call you out of order and direct you to limit your testimony to items listed on the agenda. Testifiers' mics will be unmuted when it is your turn to testify. If you're not audible, you'll be muted and the next testifier will be called. Our oral testimony online will be limited to 5 minutes, and your mic will be automatically muted once you have completed your oral testimony, or if your allotted time for your testimony expires. Please log off after testifying, otherwise staff may be forced to remove you. All right, let's get this meeting started. First item on the agenda, approval of minutes from the Committee on Investment and Land Management dated March 19, 2025. Anyone signed up to testify on this item?
No testifiers.
Mr. Chairman, I'd like to move to approve the minutes of
Mahalo, Vice Chair,
Committee
John Waihee, seconded by Trustee Akina. Any discussion?
Nope.
Right on. Can we get a roll call vote, please?
Aye.
Trustee Ahuna?
Aye.
Trustee Akaka?
Aye.
Trustee Akina?
Aye.
Sorry. Trustee Alapa?
Aye.
Trustee Galutaria is excused. Chair Kahele? Trustee Lindsay? Vice Chair Waihee?
yes.
Chair Souza?
Aye.
You have 8 votes.
All right, motion passes. Mahalo, members. All right, moving on. Item number 4, new business. Oh, sorry, item number 3, unfinished business. Seeing none, we'll move on to item number 4. Action item ILM 2506, the reappointment of Leilani Kūpahu-Marino Kahoʻāno as a non-OHA limited liability company manager for Hi'ili Aloha LLC for a 3-year term from April 1st, 2025 to March 31st, 2028. Anyone signed up to testify?
No testifiers.
All right, mahalo. Stacey, I'm going to call on you to introduce our members here. Thank you.
Real quick. Chair, is it possible to make the motion and then, because I'd like to make the motion to what I if can right now before we even begin.
Yeah, I don't see why not.
Okay.
You going to make the motion?
Chair, I'd like to move to make the motion for ilei to Kahoʻāno to be on the LLC board, the ilei board for 3 years. Right?
All right, motion made by Trustee Ahuna, seconded by Trustee Akaka. Before we take the roll call vote, we're gonna bring them up to go ahead, Stacey.
Mahalo Chair. It's my pleasure to ask Richard Pizzulo and Leilani Kūpahu-Marino Kahoʻāno to the table.
Hey, aloha, you guys. Aloha, Richard and Leilani.
Chair, trustees.
Thank you for having us here today. We're honored. And I'd just like to say that myself and the other two managers highly recommend Leilani for reappointment. She does an outstanding job. She brings a strong cultural element to our management team, and she's very dedicated to Waimea Valley.
Mahalo, Richard. Auntie Leilani, would you like to say a few words?
Sure, mahalo. Mahalo to Kapuana, Stacy, to Chair Keone, and to all trustees. Thank you for the last 3 years, and to our community that also supports us out at Waimea Valley, to Richard, and to the two other managers, Bob and Greg, excuse me. I thank all of us as we move forward. I also appreciate this reappointment. Thank you again. Mahalo.
Mahalo. Members, any discussion? All right. Oh, Trustee Aquino.
Just Leilani and Richard, mahalo for your service. You've done an outstanding job and we're very proud of what you do. Mahalo.
Mahalo.
All right. I also agree. Richard, thank you for your service. And Leilani, we've seen you out there in different capacities serving our community. So mahalo to you as well. Can we get a roll call vote, please?
Aye.
Trustee Akaka. Trustee Aquino.
Aye.
Trustee Alapa.
Yes.
Trustee Galataria is excused. Chair Kahele.
Aye.
Trustee Lindsay. Vice Chair Wahe'e.
Yes.
Chair Souza.
Aye.
You have 8.
All right. Motion passes. Congratulations. Thanks for being here today. Mahalo. Thanks.
Much.
Let's go. Can move on. All right. Come on. All righty, members. We're going to move on to new business. Item number 4, B, informational briefing by Consequent Capital Management, LLC, on the Native Hawaiian Trust Fund. Current market conditions, the role of fiduciaries in uncertain markets, capital preservation as a portfolio allocation, fixed income. We welcome Vijoy. How you doing, Vijoy?
No testify.
Aloha.
Oh,
Aloha,
no testifiers on this item, correct? Mahalo. Go ahead, Vijoy.
Aloha trustees, aloha chair, Kapuana, and staff and stakeholders. It's so nice and warm to see the previous agenda item and how well the people are doing for you. And it's a nice lead in for me because the markets are going through a lot right now that aren't as heartfelt or deserving a hug, but we can talk a little bit about that as we go. So my name is Vijoy Chatterjee. I'm with Consequent Capital Management, and we are the consultant to the board on the Native Hawaiian Trust Fund. And of course, we work closely with the board to help with that. And then we also work with staff as much as possible and to execute, not that we're executing, but that we're assisting the staff on the execution of trustees' policy in terms of management of the portfolio. So if we go to the second page, I have a little bit of an outline there in terms of the agenda. And it's very topical, current market conditions. So we'll chat a little bit about that. I have an example and an illustration about 3 types of asset allocators as kind of the second item. And then we get, like we did the last several times I've been up, take a look at the overall portfolio structure, and then we'll dive a little more deeply into what is called the capital preservation allocations in the portfolio, which is largely the fixed income and sort of more liquid cash-like investments. And then we can kind of conclude with some public market topics and trends, what's going on. Again, maybe a little bit reiterating agenda item number 1. So if we can go to the first, the next slide there, page 3. these are just a few market indicators. I can go through these slides just very briefly. The message I want to leave with you is, we've just finished the first quarter of 2025, and you may be aware it was one of the worst quarters since 2022. The S&P 500 was down about 4.5%. The U.S. stocks underperformed global stocks by nearly 9%, which goes back, the last time that was such a poor performance by the US versus the rest of the world in terms of equities, you have to go back to 2009, the great financial crisis. So we're coming off of a very challenging quarter, and we talked a little bit about some of those headwinds and challenges we might face in the quarter as things have become more apparent in terms of the uncertainties, whether it's in Washington or in inflation, interest rates, and just opportunities. And so you'll get a full report in terms of the Native Hawaiian Trust Fund and its performance in the first quarter when staff does its regular briefing for you after all that information is kind of compiled and put into a report in the next month or two. And that's part of the normal course of staff informing you of the performance and drivers of your portfolio. But just so you know, at the big level, there's a lot going on in the market. Now, on top of what happened in the past quarter, you probably are aware today was also a big day in the market in the sense that the U.S. has decided to implement a number of tariff policies. So in terms of the current market conditions, today was positive in the markets, public markets in general. But since markets closed and a lot of that information started to come out, where it looks like the U.S. will be implementing reciprocal tariffs with different countries, 10% across the board is what I'm understanding. In the case of European tariffs with the U.S., that's going to be 20%. I think China is as high as 34%. Now, a lot of the devil is in the details and how this sort of will be implemented, and is this going to be in place for a while. But I can tell you, as of an hour ago, the markets, which at this point are closed in terms of stock markets in the U.S., but the futures markets, which is a derivatives market based on underlying values for the stock market, do trade in off hours. And so as of about an hour ago, I saw that the large U.S. stocks that measured by the Dow Jones were down about 3%. The S&P 500 was down nearly like 4%. And the NASDAQ 100, which are the largest NASDAQ stocks, not the entire index, but the 100 biggest stocks, which are basically your big technology stocks, were down already 5%. Now, futures and overnight trading, they can move around a lot, but that's a very clear, deliberate direction that's going on right now. So just so we understand the kind of conditions that you're under. And then, when I was involved with managing public assets for a large plan, usually we correlated pretty closely to the S&P 500 in terms of our asset allocation. So if I knew where the S&P 500 was, I had a good indication of kind of where our portfolio was. And as you recall, probably from some of our previous comments, about 70% of your portfolio are in those growth-oriented, equity-like investments. So you can kind of estimate maybe, I don't know what your correlation is exactly, but 70% of that return is probably what you're experiencing. So it's probably down. I'm certain it's down. And we'll kind of see where things go from here, because a lot of it, again, is being driven by policy as opposed to fundamentals in the markets. But we can talk a lot more detail. Coming back to page 3, in terms of the market conditions, I just wanted to give you kind of big picture. All the charts except for the top right-hand side chart, the one with the most squiggly line, those charts are all basically since the 2020, about March 2020. The other one goes back, I think, about to the great financial crisis. And so all I just want to set here in terms of what we're looking at is on the top left corner, there's, as you look at the page, that's the federal funds rate. So that's the inflation target, policy target interest rate that the Fed sort of controls when it's responding to monetary policy conditions. And you can see since since a few years ago, we had the rates going up, and then they were held steady, and then last year they were starting to bring them down, and now they're kind of being held steady again. The important thing to note here is where you went through a period where interest rates based off of the short-term Fed policy target were near zero, and so subsequent rates like mortgage rates and stuff were based off of that. Money was considered very sort of easy to get, easy to borrow, easy to finance. It's settling in at a rate much higher than that, maybe around 4%. So that is a different environment that you're operating in right now, and the Fed will adjust this rate based on what it sees in the marketplace. And as we just started out talking, there's a lot of uncertainty. So it's not likely that policymakers will want to adjust this rate very quickly, although they have certainly shown the ability to make quick and large adjustments when warranted. And I would expect the same if it comes to that. Now, the bottom left chart there is basically the inflation rate. So you can see that big draw up of inflation, and then over the last couple of years, it's sort of come down a little bit. We don't know what the current policies will have in terms of inflation expectations going forward, but there is that uncertainty, and there's maybe some expectation that that trend could change. It doesn't show in the numbers yet. It's still very positive direction where inflation is going, but that might change even as of today's news. So that environment is why the chart above it, the Fed policy adjusts to try and control and moderate inflation. And really, it's unexpected inflation that the Fed is focused on, not just, they have kind of a 2% inflation target. What that means is that if the economy grows with 2% inflation and everyone can kind of know that in advance that, okay, we're going to have about 2% inflation, you can make a lot of decisions around that, investment decisions, policy decisions, contracting decisions. It's when you have spikes or you don't know where the inflation rate is going to be or end up, that's the risk to the economy in general and to decision makers. So we'll see that may become a little more uncertain. The bottom right chart is a chart that measures U.S. consumer sentiment. So I know it's kind of hard to see. Hopefully, maybe in your papers you see a little better. But anything above 50%, and everything on that chart is basically above 50%, that's considered positive. When it goes below 50%, that's when sentiment of the American consumer is negative, implying that they're not certain about their future, they're concerned about economic conditions. So it's still positive, but you can see it's kind of turned down there at the end of the chart, right? That's a little bit when you hear, this doesn't necessarily have the data in it yet that, federal workers have been losing their jobs or people are concerned about what changes in economic policy mean for the economy, but it's starting to show up. And I don't know if it'll become negative, but that'll be a real negative sign because remember, the consumption in the measurement of the U.S. economy accounts for about 2/3 of that measure. So the health of the U.S. consumer is very important for the health of the U.S. economy and therefore also the global economy. So we watch that as an indicator. And then the top right there is just another interest rate measure. It's the 10-year yield, and that's a measure that a lot of businesses, interest rates, mortgage rates tend to kind of focus in on terms of financing cost or financing risk. And so you can kind of see it's also in a little bit of a holding pattern there, but it's higher than it normally would have been, or it wouldn't have been coming down as much. We go to the next page now. So this is an S&P 500 chart, but it is basically the difference between the S&P 500 today versus a year ago. So it's not what today's market is. It's showing a differential from a year ago to now. It's not as straightforward as probably the things you see in the newspaper, but I just wanted to show it because what it indicates is where you see it goes negative and then it goes positive. Remember when we were getting at late last year after the election and before the election, the S&P 500 was hitting new highs. A lot of that AI excitement and technology was sort of driving the returns of U.S. stocks and the S&P 500 in particular. but you can see that it has had those sort of areas where it's dropped, and where it drops versus a year ago, that's probably indicating that your average return over a year, over 3 years, over 5 years will tend to come down. So what I'm trying to convey with this chart or this explanation here is that over the next year, you've had some very nice returns. The markets have had some very nice returns. Institutional asset asset holders like yourselves have very good numbers that they've posted over the last few years. But as these numbers kind of come down and become less certain, your averages will come down. And so over the next year or so, if you do see that your returns are down, that is because of what's going on in the marketplace, and that is prospects. But there's also just pure math kind of involved here. So it's important not to overreact. And we'll talk about overreaction and as fiduciaries, how you should consider what's going on in the market now in terms of your policy making and your decisions in the next couple charts. So if we could go to the next chart or the next page, page 5. Okay, so this is very topical. You as fiduciaries for the Native Hawaiian Trust Fund have to think about how do you take in and what kind of an investor you are, right? So this is another way of thinking of it. And I'm outlining 3 different types of investors. This could also have been a nice little matrix to look at how you compare to one another. But I'm gonna consider the tale of an individual investor, just as a generic and whatever that means to you. An absolute return investor, which again, remember when we're talking about growth strategies, absolute return investors tend to be your hedge fund managers. They're risk oriented. They're trying to generate strong returns, risk managing that over time. And then benchmark investors, which is the similar to yourselves as asset owners, right? You build a portfolio, you have a benchmark, you measure, are you doing well or not doing well versus that benchmark. And sometimes that benchmark is like an index. And to contrast that with the absolute return investor, who's one of the important characteristics is they risk manage their exposure. Benchmark investors tend to just want exposure to different asset classes and different benchmarks. And so in a way, they're not risk managing. So for example, when the S&P 500 I just mentioned in after hours trading right now is down 5%, right? I expect that your State Street S&P 500 manager is down about 5% or 4%, I think is what I said, 4% right now. And that doesn't mean they're doing a bad job. They're actually doing what you want them to do. They are giving you the index return, right? So if you don't want that to happen in down markets, you need to bring in a skilled manager, an absolute manager, a different type of strategy than one that's giving you that low cost S&P 500, for example. So you'll probably see in the quarterly report that, hey, State Street is down just like the market. But that's exactly what you want them to be doing. And if you want some other sort of risk managed return, a better opportunity somewhere else, then you look for that with other strategies. So let me go through a little bit then in details of these different kinds of individual investors. So individual investor, I'm thinking about like, you know, the average person with their 401k or a high net worth individual, a strong personality, they just hate to lose money. I never want to lose money, okay? And that's reasonable. I think we all kind of can feel that as just being human. An absolute investor who's supposed to have skill and professionally trained, they're going to accept losses if they can get bigger returns in the future. They're looking for asymmetric return payoff. So they're willing to take losses now if they know they're going to get a larger payoff later. And they, again, like we can talk more about risk managing, but that's kind of how they go about doing. The benchmark investor like yourself, the loss, the real pain that you feel of loss in the portfolio is really only when that's in a permanent impairment of your portfolio, of your body of assets. So the market going up and down, day in, day out, year in, year out, as long as you're not being forced to sell your assets, as long as you don't need that money to do something like a loan program or put up a building in the near future, you're not going to actually realize that loss. So it sort of moves around a lot, but you can, because you're a long-term investor, these benchmark investors, these asset owners like yourselves tend to be long-term investors, they can deal with the fluctuations in the market because they're not forced to have to realize the loss. If for some reason you do have to realize the loss, that's the real pain, that's the real risk to you as fiduciaries and portfolio managers or as asset owners. The second bullet point for all of them talks about risk, okay? So what is risk for these different types of investors? So in terms of the individual, risk tends to fluctuate based on conditions, based on, this is where a lot of behavioral economics, if you've kind of heard the psychology of the market, people make bad decisions because they're presented an investment in a certain way. So the example I have here, and there are so many, in fact, they've given Nobel Prizes out on the study of kind of behavioral investing, is this idea of like house money. So where does the money come from? If it's money that you've earned, you know, like in your job and you worked hard for it and now you're investing it, you're going to have a different idea about loss there. You're not going to want to necessarily lose that. But if your uncle or aunt comes along and gives you, hey, here's $1,000, go invest it or do whatever, you're like, hey, let's go for it. Let's go have a good time. You know, let's spend it or let's invest it. If I lose it, no worries. It's house money, right? That's the mentality that they talk about. So the point, individual, these kinds of, this type of investor, their risk tolerance varies based on market conditions. Now, the absolute investors, on the other hand, when they think about risk, it's a calculated risk return kind of trade-off. They're looking for skewed returns. We say that's asymmetric returns. They want to invest heavily when they think there's a greater chance, a greater probability of a big payoff, and they're going to invest less if they think there's a greater chance of a loss, right? So they want, instead of that normal bell curve you kind of remember and heard about, the sort of a distribution of potential returns, they want to see not a normal bell curve that we kind of grew up doing Bayesian economics and stuff around. They want to see something where the chances of you actually making something, they're going to bet heavily. You know, the big example, if you think back to George Soros, the financier back in the early 90s when he sort of broke the bank in England and made a lot of money off sterling coming off the UK currency coming off of the exchange rate mechanism, which is what the euro was at the time. That was because he saw the chance to really make a lot of money quickly. He had that asymmetric thinking. And so he took a big risk, but he felt he was going to get a big payoff. And that's in fact what happened. This is ancient history, goes back to the early 90s. So, but the point is that an absolute return investor is doing a lot of analysis and trying to look for that asymmetric returns. And these kinds of managers are in your portfolio. They're in your diversifying bucket, but even you can say some of your growth managers have that sort of mindset. The third type of investor, again, the benchmark investor, the closest, sort of the Native Hawaiian Trust Fund is a risk is a long-term risk, right? So again, it comes back to the idea the day in, day out fluctuations in the market doesn't matter, but I want to make sure that we're going to get, like, for example, it used to be Ibbotson and others did research and said, you know, the S&P 500, the stocks in the US will return 8% over 70 years. So you could kind of feel like, okay, if I'm a long-term investor, I'm going to make a lot of money just staying in the marketplace over that period. But there is the risk as fiduciaries, like every investor, because we're all human, is that we become short-term focused and we take our eye off that long-term return that you're trying to generate. You're trying to do too much, make too many decisions in the short term when in fact it doesn't matter. I mean, I don't know if everyone in the room is old enough to remember where they were in 1987 when the big crash came. I remember exactly where I was. And everyone thought it was another Great Depression kind of, and we're upon us and the world had changed. And yet now we barely even notice it. If you look at a chart of returns, it's one of those little wiggles that you don't even notice anymore based on where markets have gone. But so if you're a long-term investor, that's fantastic. You can deal with a Black Monday, Black Friday? It was a Black Monday. That kind of volatility you can deal with, because if you did invest money at that time, or you were investing, you kept invested, you've done really well over time because you're a long-term investor. That's what you are as fiduciaries here. The third bullet point there is the idea of what do you do when markets are uncertain, when markets are moving around like this, people like to go to cash. You maybe hear your relatives or people in the community like, you know, should I be in this market? Maybe I should just take all my money out, put into a CD or keep in the bank or keep it under my mattress, right? In fact, there are institutional investors who have approached us Consequent and asked, you know, should we take our money out of the market now? I wasn't with Consequent at the time, but they have a client, a university, not a big university, but a university that was a client that in April 2020 put half their portfolio in cash. Now, these are highly educated, you know, people running a university endowment, and against all the advice that Consequent was giving at the time, which was a ton. It was we have the emails that show saying, don't take your money out, just hold on, stay where you are. We can talk about rebalancing, but don't take your money out, don't put it in the cash. They took half their portfolio out, put it in cash in April 2020. And if you recall, where did the markets go after April 2020? Essentially, straight back up, right, after the scare. And as of the end of 24, or maybe middle of 24, I think still half of that money was still in cash. That's the other side of it. When you try to be too cute and you want to just like put the money on the mattress, you tend to never put it back in the market or know when to put it back in the market, right? And so that's what is, these sorts of investors will tend to make mistakes because they think, let's just be out, instead of thinking, hey, how can we make money over time, and being a little more disciplined about it. The absolute investor, again, these are like your hedge fund types. They actually think of cash as an asset class. So what does that mean? Like they have a allocation and they will put a lot of their investments into cash. But if you're investing in, like, say, a hedge fund manager, paying them 2 and 20 fees, you don't want them to be in cash. You want them to invest and return money. But the reason they're able to do that is that's part of their strategy. They won't invest if they think valuations are too high or that they're going to have a bigger opportunity down the road. And that's that skill that you pay for. You know, you say, okay, you guys think of cash mentally as an asset class, and you use it as a way to enhance your returns. So they're not going to sit on that cash from 2020 to 2024. They will have immediately reinvested it. And that's what they should be doing. That's why they're so-called smart money and skilled investors. That's why you pay them high fees to do that sort of thing. So for them, cash is an asset class. And that's a very specific way of thinking about how cash is used in a portfolio. Now, for the benchmark investor, for the asset owner, cash is really considered a drag, meaning it hurts your performance. That's why a lot of, including yourselves, your policy will say, we can't have, you know, our target allocation of cash is 0%. We can't have more than 2%. I've seen some institutions that might have 9%, 19%. I don't understand what that's about, but it's considered a cash drag. And if you were to have a lot of cash, be holding a lot of cash instead of investing the portfolio strategically with under policy for the long term, that would be a dereliction of your fiduciary responsibility. And that is applied more so to other types of plans that are governed by the ERISA rules and things like that. But you guys aren't governed by that. But you still, as institutional investors, should think that you want to be invested at all times in all markets. Now, so that's that last point there, the big point that, you know, as a benchmark investor and a fiduciary, you should remain fully invested over all market conditions. Now, that doesn't mean you should always be levered up and in really risky assets, even when markets go down, up and down, because on the one hand, that isn't prudent. So you want to have a diversified portfolio, and you talk about the way you diversify that risk. And on the other hand, you have needs for your money, right? You're not just invested forever, right? There are specific ways that OHA wants to use the portfolio to fulfill your mission. And at different times, you're going to require liquidity and cash from the portfolio. So you have to structure your investment portfolio so that you have that liquidity buffer, or you have that ability to draw out funds when you need it. Now, ideally, you're going to not be doing it today, because you're kind of going to be selling at the bottom of the market. But that's, again, that's why you have policy. That's why you want to have your investment staff. You want to have your investment consultants. You want to have, you know, expert guidance on how to structure that so that you don't get yourself in a situation where you're forced to overreact or sell exactly at the wrong time, like, say, this individual investor example here. So any questions there? Otherwise, I'll move on to the portfolio, and I try and keep things a little bit short, but I think it's very timely to have that sort of presentation and material in front of you, and know that there are real decisions being made right now. And so knowing what kind of investor you are, who you are as an investor, what you're trying to achieve in the markets, go back to your policy where we talk about values and why you invest in capital markets. This should have some ability for you to then know, okay, this is why we're taking the course of action we're taking. This is why we're following the policy as of such.
Questions? Chair Kaile? Oh,
Have you, Joy?
Hi, Chair.
Hey, thanks for kind of setting the stage for what's about to come, I think, to the global economy. I mean, just as you're speaking right now on Wednesday night, the Dow futures are down 1,100 points. I don't think tomorrow is going to be a good day when the opening bell happens at 9, 10 a.m. I mean, what are your thoughts in terms of what the global markets, you know, will do in the next, I guess, few weeks, and how should we as fiduciaries, you know, working together with Ryan, you know, keep an eye on where our investment portfolios are, and are others would be looking to move money into different categories to weather the storm? You know, I'm sure personal investors are doing that as well. Do you have any advice or thoughts on that? I mean, what this administration announced today and the global ramifications of that are going to be, I don't think we've seen something like that in quite some time.
Right.
You know, I mean, I guess the last time the United States ever imposed tariffs of this magnitude was in 1930, and that exacerbated the Great Depression. So your thoughts on?
So, sure. So, I mean, so my thoughts are worth probably what you can write on any piece of paper. I don't have any special knowledge or ability to foretell the future of what's going to happen going forward. And especially in these conditions with the policymakers in place, it's very difficult to kind of know what direction or for how long that direction will continue. What I will say, as a prudent sort of fiduciary of an institutional quality portfolio, is you want to continue to follow your policy. You want to continue to build out your private markets, which is what Ryan is doing. Sort of, well, when we work with him, we see him day in and out doing that. He's doing a lot more, but that's sort of where we've been contributing. Then we've been talking about restructuring your public market. So that process of restructuring the portfolio for the long term is something I think where you want to keep your focus. Now, in terms of the response to what's happening in the market today, tomorrow, probably no response, because we just don't know. But if you think, and this is a conversation worth having at your level of policy, if you think the changes going on in Washington are really going to be long-term, I mean, whether or not, you know, leaders in Washington change or not, but fundamentally the policies and the consequences of those policies are longer term, you know, not going to change, you know. I don't want to speculate, but, you know, say certain treaties or alliances go away, and it's just very hard to put them back together exactly the same way. That's a long-term change, and that might have implications for the policy. Both good and bad, right? Because you can talk about, okay, what companies will do well in circumstances, what companies might not do well. Do we have managers that will be able to get there? So that's kind of a conversation worth having. Is it worth restructuring, thinking about your asset allocation? The other aspect I think that I would advise all asset owners to have, and this is just through all market conditions, is that you have a stronger risk mitigation type strategies in the portfolio. And so risk mitigation strategies, you can think of it as like that. We talked a couple of weeks ago or a couple of meetings ago about the capital appreciation part of the portfolio, right? That's the carbohydrates, that's the growth part of the portfolio. That's great when markets are going up. Now it's not so great when markets are suddenly down 5%. So what offsets that? So you have that component, which we'll talk about another day, called the diversifying strategies. And so within diversifying strategies, you can think of these kind of uncorrelated, which is a way of saying, like, when stocks go up, these investments go a different direction. Maybe they go up when stocks are going down. Maybe they hold steady, go down a little bit when stocks are going up. Having that in your portfolio to kind of, balance and stabilize in these sorts of conditions, hopefully allows you to then hold your positions, not be forced to sell, when markets are uncertain, so that you can participate when things settle down and markets readjust and then kind of continue to grow, whether maybe not at 20% growth, but maybe at the historical 8%, which still allows you to achieve your mission as an organization, which is the key, right? It doesn't matter if you make money or lose money in any given year. The important thing is that you achieve your mission as OHA over the long term, intergenerationally, right? And that's what the portfolio needs to support and do. So even though it can be difficult and, we want to go and say, tell me the answer, what should I do with my money? Sometimes it's like, don't do anything, or don't make decisions in these stress conditions. The ideal time is to have this conversation before we get to these stress conditions and know what you're doing. So a lot of times with that risk mitigation type strategies I'm talking about, I said they go up when stocks go down, but part of that conversation is not like, oh, let's invest in those strategies. There's also like, okay, now we need to rebalance. So when stocks are going down, you should actually maybe be, if this is what you believe as an investor, when stocks go down, you want to rebalance and invest in those stocks so you can catch them going up. Now, again, there are people who might disagree with that particular point of view, or in certain circumstances, maybe they don't think it's different this time, and so let's not rebalance. But going into stress markets, crisis markets, that's a conversation you have. So as policymakers, we know, hey, we know what happens when the market goes down 8%. We know what's going to happen. Ryan's going to walk in and he's going to say, we're going to rebalance the portfolio. We're going to take money from our risk mitigators and we're going to put it into here, and we're going to do that halfway. And then we'll put the other half in, if depending on where markets go. But that's a strategy and that's a discipline. And as an institution, that's what you need to kind of drive your policy making. So it's very transparent, you're accountable. And personally, I think that will actually achieve your goals over the long term. So right now, I think you just sort of stay the course. You put in some new policy. Maybe you think about reallocating, like, oh, should we have 70% in kind of risky assets? Should we have it in something else? And we'll talk about the something else in a minute here. But that's sort of the advice. Okay. It's never a good answer, but that's what you get from a consultant. Oh.
All right, mahalo, Chair Kaele. Joe, you can move on. No more questions. Thank you.
Okay, if we can move to the next slide. Okay, so you're familiar with this slide, and you see this in your, I think you guys get the reports from Northern Trust every quarter. And so this is on page 11 or 12 or something like that in the report. And it just has more colors based on what I've done with it. But we saw this before. In the far left column, you've got your asset classes that you've invested in. You've got in the next column over the risk strategies, which I've spent a lot of time using the language there of capital appreciation, diversifying, and capital preservation. Then this was the weight in the portfolio as of the end of December of 24. Those are your target weights, which is those are your policy weights. And then the market value of that at that time. And then again, what you saw is that you are underweight in your private market, private equity, and you're overweight in your public equity. That has been great up to this moment. Now that things have gone haywire in public equities, we're going to feel that a little bit, but you should expect that. And the idea was we needed to right the ship when it came to the private markets. So that's why Ryan was focusing on executing and using the discretion in a box to build up your private equity, and that was going to come from your public equity. So we weren't talking about changing the risk in the portfolio. We were just talking about, at this point, getting to the risk and the policy allocation that you had previously approved. And that's a multi-year process. So before that process is completed in 2030 or 2029, whenever that you get to your target private equity allocation, we will probably change those targets. And maybe this year, and maybe because we think, hey, some of the changes going on now in terms of the U.S. economy and the global economy are going to last. That's a conversation worth having. You should have that with your staff. You should have that with your consultants and amongst yourselves. What that means for the portfolio. So that's your portfolio. Today, we're actually going to be talking about the fixed income, enhanced liquidity, and cash, which is your capital preservation allocation in the portfolio. It's a little under 20% here, and its target is a little over 21%. So you're a little underweighted to it, as you can kind of see there. Okay, so let's go to the next page, please. Okay, so capital preservation. So last time we talked about your capital appreciation assets as being your risky assets, of being kind of the carbohydrates, if you will, the bread, the rice, the taro in your portfolio meal. So what are your capital preservation assets? Think of them more as like your salad, your vitamins. Nobody really wants them. You don't want that much of it, but it's really necessary kind of in your portfolio. Capital preservation assets like fixed income, and this used to be just like government bonds, right? So you know that if you bought a government bond, you're going to get some coupon. The price of the bond might change during the course of you owning it, but at the end of the day, you're going to get all your money back. So you know, forget about inflation, forget about what else is going on in the world. You got your money back. You feel good that, okay, that's a safe investment. And in fact, for most of the 20th century, for institutions and even individuals, that's all people would invest in if they invested at all outside of their home or something. They would own bonds, and it would be considered risky to own a stock. A stock would be saying, oh, you're speculating, you know, that's too risky. You shouldn't. You as an institution, 100% bonds. Now, the challenge over time is we learn, well, maybe stocks aren't as risky as we thought they were. Maybe there are ways to manage it. Also, maybe if you only invest in bonds, they don't keep up with the rate of inflation, especially if inflation spikes. Therefore, you end up with the real loss of purchasing power over time by just owning the bond. Even though you got your capital back, that capital can buy less than what you did when you first invested in. That's why then eventually institutions were allowed to diversify beyond bonds. And there are still institutions, I know federal institutions right now who have portfolios of assets, they're only allowed to invest in US Treasuries. And that hasn't changed, and it'll take an act of Congress to get that to change. But a lot of institutional investors, whether in the public side or the private side, now own stocks and bonds. And in fact, you know, some asset owners own a lot of alternatives, so even more sophisticated strategies, and that's an even more recent phenomenon. But traditionally then, so what has the role been as you sort of had a mix between stocks and bonds? This is kind of the less correlated or the offset to your growth. People kind of said you're either, you know, investing in risky assets like stocks because you want to see that capital appreciation, or you're looking for safety, so you're investing in bonds, highly rated credits that you know you're going to get your money back at the end of the day. Now, over time, fixed income has also changed, right? So it's not just U.S. Treasuries with its gold AAA stamp, which it doesn't even have anymore with some rating agencies. But it wasn't just a contract. It was also they were investing in so-called high yield bonds, right? In fact, they used to have a worse name for they called it junk bonds, right? Which was just really high yield bonds that were used to finance more speculative and growth type companies. Because remember, again, you know, at the very basic level, right? Stocks give you an ownership in a company, and a bonds you're lending to the company to carry out their business, right? That's basically the difference in terms of the types of capital here. So it gives you different rights to the assets of the investment, whether it's a company or what have you. The role that this part of your portfolio has played or traditionally play for the most part is to give you something that provides a little more stability. So some income stream, some certainty that, you know, your assets are going to be there down the road when you get your investment back. And again, it can vary because you'll see you have some high yield funds in there. So high yield bond funds tend to be more like equity. They're a little more risky, but they have higher returns. And so you have some of that. So your fixed income has also evolved. It isn't the traditional 20th century, very safe government securities, municipal securities, where you have the backing of like tax receipts or the full faith of the government to make good on its borrowings. So that's kind of how it fits and works in your portfolio. You also have the enhanced liquidity and you have a cash component. I said that cash should be basically zero. That's the ideal, but there's always like sometimes friction. There's movement of money. You need, things are maybe moving to help finance operations or activities. So sometimes there'll be cash in there, and that's a very reasonable amount to have in for a portfolio like yourself. The enhanced liquidity, I think there's probably an idea over time that can be used for projects that OHA may undertake. And so while you want to stay invested, they're in more short-term type investment vehicles that can get liquidated fairly quickly so that you can then use that money for specific needs or projects. And that's also acceptable. Again, that's a discussion that you have at the board level with your team, and then you come up with a plan, and then that's sort of all under a policy that you guys work through. So that's kind of where that sort of fits here. Okay, so I think that's all I want to say on this page. If we can go to the next page. So this is actually from one of your quarterly reports, and it just breaks out your fixed income, your enhanced liquidity, and your cash holdings into the different accounts. It's just like the performance report you saw for your capital appreciation type investments, your equity investments. You've got the name of the fund, you've got the market value as of, I think this was the end of December. I go back and forth with the dates, unfortunately. You've got the ending weight at that period. You've got your policy weight where you do have policy. You can see there's a lot of investments and stuff where you don't have policy, and that's appropriate. You don't want to, be dictating how much you're giving with this manager or not. And then you have your period returns, different measured periods, 3 months, fiscal year, 1 year, 3 year, 5, 10, since inception, and then you have your inception date. So, you see here, like in your enhanced equity, you have a State Street fund. Also in your fixed income, you have a State Street fund. Mostly the way you use State Street is similar to the way you use State Street in the equity portfolio, where you're just trying to get exposure to the broad market. In this case, the State Street and aggregate bond fund is a broad exposure to bonds. In the enhanced liquidity, those are short duration bonds, again, where you have a lot of liquidity and where they mature quickly. So if you need the money, that's where you can go to finance things. And then of course, cash is cash, so that you want to limit. But again, if you need that cash specifically for something, you may see fluctuations in those accounts anyways. Okay, let's go to I think the last page now. So just in terms of market trends and topics, 3 indicators that you can be monitoring, especially over this very volatile and uncertain time. You want to look at the U.S. fiscal and monetary policies. The middle section there, you want to look at the U.S. and global economic growth. And you want to look at, finally, the last section there, financial markets. So in terms of fiscal and monetary, so fiscal, that's like government spending, right? So that's going to be the budget, that's the deficit that everyone's worried about, and that's the changes going on with the with employment and operations of federal agencies. And then the monetary side of the policy, that's going to be your Federal Reserve. That's looking at the interest rates, that's monitoring the financial system, that is watching for inflation pressures and changes there. And then also in the U.S. fiscal and monetary, the very topical today, the idea of tariffs, what that means, and geopolitical positioning. So tariffs, we're finding out in real time right now, what's the impact, what it means. And it appears the markets have reacted strongly, which could be severe, but markets do tend to overreact, but it's not insignificant the amount they're reacting. So there is real concern out there about what these tariffs mean for the future of the U.S. economy. And so that's why we go to the next section there. And we talked about consumer sentiment and spending earlier in the chart in this presentation. We also talked about borrowing cost and options available in terms of borrowing and financing. So, the ability for people to finance the growth of their business, or to buy a home, to finance education. Those are all kind of things that are part of the economy. And then, of course, the adoption of technology. So where is AI adoption this year, and does it really increase productivity? Because it's that productivity growth, and economists have a very specific definition of what productivity is. But if there is real productivity gain, then you should see that expressed in the growth opportunity for the economy. But if it's just sort of, now I gotta, go to the when I go to CVS or Long's, I gotta check out stuff myself. I don't know if that's productivity gain. That's just making me work instead of the way it worked before. But that's my own like kind of pet peeve with the having to check out my own bags. But anyway, that's aside. The last thing there, and I think I'll leave it here and answer questions or just finish up in terms of financial markets. Again, fundamentals are corporate earnings and uncertainty. The reaction in the last few hours to corporate earnings, that hasn't changed anything, but there is implication that, companies may not be able to operate the way they were before, and they may have to make some real changes, which may lead to short-term cost and losses. And so that potentially is something that, could change the outlook for the U.S. economy and the global economy. Remember, the U.S. economy was very strong going into this quarter. At the end of last year, the consumer was resilient, companies were doing great. So if this is a long-term change, then we're going to have to adjust to that. Private markets, which again, you're spending a lot of time restructuring your private markets portfolio right now, but there have been, even before this election and before this change of administration, there have been issues in the private markets in terms of exits. So you remember like in the 90s and early, there were a lot of IPOs, right? A lot of companies, they don't even have earnings and they go IPO, and then everybody wants to get a share of the IPO because it's going to double, triple, that sort of. You don't hear about a lot of IPOs right now. That's a big exit vehicle for private market firms. So the fact that they can't exit that way has made it challenging, and that's something to watch. If the IPO market comes back, that'll be very positive for your portfolio. If it doesn't come back, that means your portfolio is going to kind of tread water, at least in that asset class and maybe overall over time. And then there's a lot of financial markets. What's the speculative sentiments and what are the risks of a real financial crisis where there's contagion? So speculative sentiment still is around technology. It's AI. Again, what is the impact of AI? What is the impact of the technology changes in the economy, whether it's in health or in business activities, in general, social media? And then contagion, which is always something that we're worried about because that's a real financial crisis, and that can come from the markets or it can come from the real economy. And if that were to happen, then we're talking about a different type of market environment than we have right now, which right now I would characterize, going back to Chair's question, what to expect is that right now the market is reacting to changes as they become known in the marketplace. It's not a crisis. It's not a economic disaster or, we're headed to another depression, but there's some real policy implications for what's going on. And all of us as investors and just as individuals are trying to work through that right now to understand what are the prospects for the future. And so that is the very exciting and uncertain moment that we're in. And I appreciate the opportunity to present that.
All of you, Joy. I'm surprised that you can keep it 10 minutes every time. Members, no questions. Members, any questions? Sorry. Go ahead. Trustee Wahir.
Troy, are the fees like surrounding the fixed income activity, are they very low?
I wouldn't say they're low, but I think they're reasonable. I think they're reasonable, but if you're kind of interested, like I think sometimes there's interest, like in the equity markets, to sort of say there's a big contrast between the actively managed versus the passively managed. And the passively managed, the fees are really low, and sometimes the actively managed, the fees can be quite considerable, right? In fixed income, the general idea is that we like to have them actively managed, but there are more tools available today. There are ETFs, there are passively managed fixed income strategies available, which then presumably would have lower fees. I don't necessarily see that yet, but I'm open to being proved wrong that, hey, those passive strategies in the fixed income marketplace can get you the same kind of return or the same kind of risk at lower fees. That would be terrific. And in fact, fees in general in asset management have been coming down. So you would expect that in all asset classes at some level. So I think you're reasonable. You can probably improve that. That's something that staff can take a look at and make an effort. And I think over time, the portfolio can be managed at a lower cost fee structure than what you see now.
How are the returns on the fixed income investments compared to like a mutual index kind of investment? Is it lower? Is it much lower or?
Could we go back to that page where we showed, I think it's, yeah, page 8, right? So a way to look at it to kind of get a feel for your question here is if you look at the manager, which if you look under the fixed income section, so it's the top kind of light colored section there, you have a bunch of different managers, right? The most passive type of exposure manager is where you have the bulk of your assets, 10% of the portfolio. That's the State Street aggregate bond, right? So, and then it's being measured against this U.S. Ag index. I don't know if you can invest in that one in particular, but it's showing whether you're getting an excess or underperforming. If you remember on the equity side, the State Street Index Fund just slightly underperformed the index. If you were able to buy just directly all 500 stocks and manage it like the index with no fees, it was performing a little better than your State Street. And I think I said that probably the difference there is because of the fees and maybe a little bit of the trading friction in implementing the State Street, but it was reasonable. In this case, I would say that's your most passive sort of fixed income exposure, and it's a reasonable slight underperformance, slight under excess return versus that index. So you're just trying to get, now some of these other managers, you have JP Morgan, I think mostly, and you have a WAMCO short dated high yield fund there. You can see that they are also a little bit, you know, depending on the year. The 1 year, they're a little bit more under. There's a lot of change in the last year in terms of high yield funds. Over the long term, you can see the JP Morgan fund is probably underperforming more than I would hope. The short dated have tended to be, there's more kind of trading or activity that you can put into managing those sorts of short dated type bond funds. But this would be a way to kind of say, okay, are they doing reasonable versus some sort of a benchmark? And that's the way you kind of would measure it. But overall, in terms of the marketplace, you know, I'm just thinking of some of the other high yield funds that Consequent would have invested in. And I think you can do a little bit better. I think these are probably sort of, you know, average to maybe a little better than average type returns. But again, in order to affect any change that you might be thinking of right now, trustee, is that you want to ensure that that's something you direct to your staff to kind of look at and consider, and how you might reconstitute the fixed income component of your portfolio. And that's a conversation, you know, that will take a little more time.
Members, any other questions? Mahalo, Vijay. Thank you so much. Great presentation. Appreciate you. Thank you. All right, ladies and gentlemen, let's move on. Next item on the agenda is executive session, item number 5. In executive session, we have a discussion on OHA's commercial real estate.
Second.
Wait, one sec. A discussion on OHA's commercial real estate leasing terms. Board anticipates going into executive session pursuant to HRS Section 92-5A4 to consult with our board counsel, Richard Naiwieha, Wurdeman, and Interim General Counsel, Everett, Ohta, on questions and issues pertaining to the board's powers, duties, and privileges, immunities, and liabilities pertaining to OHA's commercial real estate leasing terms at its Iwilei and Kakaʻako Makai properties. Anyone signed up to testify on this item?
No one signed up.
All righty. So before we vote to recuse ourselves into executive session, I'm going to read the following. Anyone online, you must log off. When we return to open session, you may log back on. If you're in attendee mode, do not log off. Oh, and do not log off, then you will be removed from the online Zoom webinar. So make sure you log off. And you will not be able to rejoin the meeting if you do not log off. So just a reminder. Do I have a motion to go into executive session?
So moved, Mr. Chair.
All right, motion made by Trustee Wahe. Do I have a second? Second by Trustee Lindsay. Call for the vote, please.
Trustee Ahuna.
Aye.
Trustee Akaka. Aye. Trustee Akina.
Aye.
Trustee Alapa. Chair Kahele. Trustee Lindsay. Aye. Vice Chair Wahehe, Chair Souza,
Aye.
with 8 going to executive.
Motion passes. We're going into executive session. We'll give you a couple of minutes to log off. Anyone online?